I try to read all of your comments on my videos, and I tend to notice that a lot of people talk about the same ETFs. Sometimes new ETFs or new stocks will come up where people say, hey, Jake, what do you think about this stock? What do you think about this ETF? And one that comes up all the time is this ETF COWZ. And I remember this because it has such an interesting name, COWZ. So I remember it. And I came across this article here on Seeking Alpha from John Bowman, and the article is titled, COWZ, Free Cash Flow is Still King. If you're interested in signing up to Seeking Alpha Premium, they are running a Black Friday sale where you'll get $90 off premium by using my link. It is an affiliate link, so I do benefit if you do sign up. The Black Friday sale will be going on until December 5th. There's a lot of things that I like about this article, and one of the things that I like the most is he does mention the fund methodology. A lot of these articles, they just talk about, the current holdings. They don't go into detail on how the fund screens stocks for the index. And so John does a really good job with explaining that. And something that I like the most is he talks a little bit about the core and satellite approach to investing. And I'm a huge fan of that approach. And so this fits in very, very well with my way of thinking. So let's take a look at it. So the summary of the article is the Pacer US Cash COWZ 100 ETF COWZ focuses on companies with high free cash flow, offering unique value and quality tilts often missing in portfolios. The ETF's methodology based on free cash flow yield identifies companies with strong cash reserves, potentially outperforming in uncertain economic climates. While COWZ has historically kept pace with the S&P 500, diversification with large cap funds is crucial to mitigate risks and ensure balanced growth. This article covers COWZ, its methodology, place in a portfolio, and suitability among investors based on its factor weights, capitalization, and more. So the article starts off with the introduction. I've never covered the Pacer US Cash COWZ 100 ETF or COWZ alone, despite its coverage alongside popular ETF SHD being one of his most engaged articles here on Seeking Alpha. Despite this, I have recommended COWZ in the past to clients of mine and believe it in its methodology as a way to search for alpha in the market. The ETF itself has underperformed the broader market, but this may be expected during growth-led bull runs as the companies held in COWZ are largely value-oriented, but more on that later. We can see that exception in the chart itself, where the only time COWZ outperformed SPX in the last few years being 2022, when value companies outperformed growth during the short stagflation episode. However, this ETF is unique because it isn't a value fund at all. Instead, it sorts based off of free cash flow, FCF, a metric that shows how much cash a company has left after paying expenses, interest, taxes, stock buybacks, dividends, and M&A activity. This ETF prides itself on the holdings having more than double the market average free cash flow yield. So you can see here the free cash flow yield. He has a little graph here of this ETF versus the Russell 100 Value Index. Okay, so the free cash flow as a criteria, FCF, free cash flow, is used to discern quality companies from others, and it is a metric showing how profitable they are even with optimal value-driven activities like dividends and buybacks factor in. This makes this ETF unique in its discerning criteria and has led to a very interesting looking top 10 list. I doubt most people would have guessed its top 10 holding. Of the 102 stocks that this ETF holds, its top 10 make up 20% of the fund's NAV, or net asset value. Underdogs, Airbnb, and Hewlett-Packard Enterprises, HPE, are its two top, which are not companies that typically come to mind when discussing quality operations. They are cash flow kings, it turns out, especially when compared to the largest stocks in the US like Nvidia and Apple. Note that this is looking at a price to free cash flow, which is not what Pacer uses to sort their funds. This is just a good way for me to show free cash flow comparisons with Y charts. My understanding is that the purpose of sorting by free cash flow yield is to identify companies that produce a lot more cash than they need to operate their business and appease their shareholders. Companies with excessive amounts of cash and a low cost of operation will score highly in this index. So here's how Pacer decides COWZ, or this ETF's holdings. So the first thing is that they look at the Russell 100 index, and then from there they screen down free cash flow yield and they look at 100 companies ranked based on a trailing 12-month period. And then what they do is they select the highest trailing 12-month free cash flow companies of the Russell 100 index. So I like that. So you're going to get a lot smaller companies. You're not going to get the mega caps. You're not going to get large companies. So you're going to get smaller or mid-sized companies in this ETF, which he'll describe here in a second. Most people don't have a lot of exposure to mid and small cap stocks. Most people, if they're investing in the S&P 500 or the total US stock market, they're overweight large cap. And it's just simply because the way that the index is set up based off of market cap. So unless you explicitly own something else, you're not going to have a lot of exposure to mid and small cap. So it's kind of an interesting take here, and he'll touch on this a little bit more in the article. The real question is, does this make for a good investment criteria? Historically, yes. However, we are not investing historically, we're investing for the future. So let's take a look at what it holds today to see if we like the underlying stocks. So the top 10 holdings, you got Airbnb, Hewlett Packard, you got Bristol Myers, Chevron, Expedia, HP, AT&T, Qualcomm, Cardinal Health, and Gen Digital. Yeah, so not your typical dividend stocks, I guess you could say, this, except for a few of them. This is a mixed bag of sectors, with this ETF being especially overweight in energy and consumer discretionary, while notably being underweight in information technology. This ETF is heavily tilted towards mid-cap value, with 40% of stocks in the fund being mid-cap stocks. This is notable because it means that this ETF more easily fits alongside traditional large-cap exposure like the S&P 500 index funds without contributing too much overlap. Many folks do not have enough mid-cap or small-cap exposure to even be, at a market average, let alone being overweight these smaller stocks. This ETF, therefore, is a boon for anyone looking to add more mid and small-cap coverage into their portfolios. So the place in the portfolio, that brings us to the question, how does one use this ETF in a portfolio of stocks? I see this ETF as being a great satellite fund atop a broad market core like a total market fund or a large cap core like an S&P 500 index. In both cases, adding an ETF like this dramatically ups exposure to small and mid cap companies, which are often left out of many portfolios without good reason much of the time. The fund will crank up portfolios exposure to several factors that are not traditionally found in large cap index funds like value, HML, investment CMA, and profitability RMW factors that you can see in the difference below. So I think a lot of people are probably not going to really understand what that exactly means. So I'm gonna skip that. It'd take me quite a while to explain it. It's a bit technical. So this ETF is suitable for many investors, aggressive and conservative alike. What investors must consider is their position sizing. The fund itself is diversified across 100 stocks and offers a factor tilt, but shouldn't be considered as a core holding. This does leave growth on the table, potentially, as it leaves out many large cap growth names that have been buoying the market lately. Names like Apple, Nvidia, which are notably missing from this ETF. For aggressive investors, I would caution against missing out on some of the growth factor, and so I would recommend that an equity portfolio should be no more than 40% in this ETF, with a recommendation for something closer to 20%, assuming the rest of the portfolio is also invested in other equity funds. I like that he mentions this and he actually gives a percentage. I think that's really good. Conservative investors are cautioned to go no more than 20% of an equity portfolio into this ETF, as it may underperform or be more volatile at times, such as in 2020 when it dramatically underperformed the market crash. I would recommend most conservative investors invested into this ETF to limit their exposure to 15% or less, ideally with 20% as a cap to trigger a rebalance. Now, it's interesting because it did well in 2022, but it didn't do well in 2020. Now, I think a lot of that has to do with the crash itself. Now, you have to remember, in 2020, people thought that the world was going to end, and for a lot of companies, that was actually the case. A lot of smaller companies struggled because they didn't have the capital and they didn't have the moat to withstand this massive shockwave that the market saw during the pandemic. right? And so what did you see? You saw a lot of larger companies, large cap companies do very, very well, right? And that wasn't the case for small caps. And so, but when we saw the correction the crash in 2022, it hit everybody. It hit large cap, small caps, mid caps. And so I think that there's a little bit of nuance, or a little bit, you have to peel back the layers and really understand why it underperformed in 2020 versus in 2022, because I actually see this as more of a defensive play. And so he's making the argument, if you're conservative, you should have less. And if you're aggressive, you should have more, where I actually kind of see the opposite, the reverse, right? And so that's at least how I view it from reading the article here. So I need to do a little bit more research, but I see this as more of a defensive play because they're focused on cash flow positive companies, free cash flow. And so, which generally will act as a floor when the market is crashing, right? Because like the companies have real cash flow that they can back up their price to earnings ratio with, right? So I don't know if I necessarily agree with this part. So just throwing my 2 cents in there. So moving on, remember that sizing is often one of the most important decisions in making an investment, as it can affect your psychology quite a bit. The more conservative an investor you fashion yourself, the more diversified you should be to temper your fear when things go south. This means lowering your exposure to any given fund so that no one investment can tank your portfolio entirely, and the diversification means that not all will drop together, or at least to the same degree. I really like that. So the only major risk that I haven't already mentioned, so this is besides the risk of smaller cap stocks being more volatile than large caps. Okay, so that's actually what he's saying in terms of the risk. Smaller caps are riskier. So I actually understand his comment now with the conservative versus aggressive. He's referring to the small caps. Okay, so that actually makes sense, understanding where he's coming from. Anyways, moving on here. So is that free cash flow yield may not end up being a good investment decision? Well, it has shown historically that it can keep up with the S&P 500 and still have a higher yield marginally by about 15%. This may not continue into the future, missing out on the largest companies in the world. This is why investors are cautioned to be diversified and hold this ETF alongside a large cap fund of some kind. Okay, great. So now I get it when it comes to the conservative versus the aggressive, and why because I thought he was contradicting himself, but now I understand what he's talking about, because small caps are generally they are riskier, right? They're more volatile. So that makes sense. So let's take a look at the conclusion. Ultimately, this ETF serves as an investment that is promising, especially for the average investor who may be lacking the kinds of tilts that this ETF offers, like value, quality, profitability, and capitalization. This fund is a diversified fund that screens by free cash flow yield, a metric I have not seen used elsewhere. It appears to be an opportunity for further diversification of an equity portfolio and to enhance that portfolio in a way few other funds are able to do. Without the use of derivatives or any other special instruments, this ETF has kept pace with the S&P 500, and I believe it is set up for outperformance as it leverages smaller companies with high cash piles that will be able to withstand negative market forces should they appear. With our current economic climate uncertain, it makes sense to invest in companies with solid backdrops. So that's the article. Now, it's a little bit confusing because he kind of contradicts himself, where he says that it's conservative, right? He says that this is, it'll help with market uncertainty or with negative market forces. But then he talks about small caps and mid caps being more volatile. And so it's kind of like, if you're confused, it's okay, because he makes it a little bit confusing. So just understand that both can be true at the same time. Small caps, mid caps can be more volatile, but with this strategy focusing on free cash flow, it can actually smooth out the ride, because the companies that are in this index, the smaller mid-cap range, they're screened for quality metrics that are less volatile. Okay, so that's kind of a mouthful, but that's the gist of what he's saying here. All right, let's take a look at a few comments. I really like VFLO, which is very similar to COWZ, but with a couple added screens. Also, a similar, less volatile alternative to COWZ for consideration is DSTL. Since DSTL inception in 2018, it's a bit ahead of COWZ with a more smoother ride. DSTL, there's a lot of there's a lot of names, a lot of tickers in this comment. DSTL also focuses on free cash flow yield as well as stable cash flow and low leverage. So it has a quality value tilt. We'll probably see more interest with these type of funds as investors are looking to diversify more as they become more cautious with the lofty valuations of heavy mega cap stocks, funds, especially growth funds that have had a spectacular run. This is a really good comment. I'd have to take a look at the other tickers that he's referring to here, but in terms of adding other parts, diversifying your portfolio outside of mega, large cap companies like Nvidia or Microsoft, I think this could be a great way to tilt your portfolio in a passive way where you're not investing into individual stocks. What you're doing here, if you're investing into this strategy, you're saying, hey, I want a little bit more exposure to a quality piece of the market where I don't have to actively pick the stocks, but rather I'm going to actively pick the type of strategy, methodology that I'm interested in, and which is, in this case, free cash flow. Then this would be a great way that you could do that, or something that you could consider at a fairly reasonable expense ratio. This ETF does have a decently sized expense ratio. It's not the highest, but it does come with an expense ratio that a little bit higher than what you would expect with other dividend ETFs that I talk about on my channel. But I still think it is interesting and is an interesting strategy. Another comment here, long COWZ, one of the best ETFs out there. Most ETFs don't come close to tracking the S&P 500, probably 95% or more. That's a fact that many do not realize. I'd have to fact check you on that one. I don't know if that's actually the case, but per his comment here, this one generally does, and I like the premise. Free cash flow, can't argue with that. So yeah, I think, it really just comes down to, do you want more exposure to companies that are screened for quality based off of free cash flow? And I do like the fact that it has kept up with the S&P 500, and the thing, though, is this ETF doesn't have a high dividend yield, so I would not recommend going and buying this ETF tomorrow or today just because, you read an article or watched a video on it, but it would serve as more, to go and do a little bit more deep dive and do a little bit more research if this is something that you would be interested in. So that's the article. Overall, I would give this article an A. I think he does a great job at explaining the methodology, explaining who should be, considering an ETF like this. And he even goes so far as explaining, the core and satellite and what percentage you should consider adding, this type of ETF to your portfolio. And, also, with the criteria as a, conservative investor, aggressive investor. The only part that I was a little bit critical on was, I thought that he was contradicting himself when talking about, conservative versus aggressive, but then towards the end of the article, it cleared it up and it does make sense. But all in all, I think this is an interesting ETF to consider as a satellite position. This would by no means, and I agree with John in this article, this is by no means would be a core position in my portfolio. This is something that, if you absolutely want to tilt your portfolio based off of the criteria and the screening of free cash flow, 5% of your overall portfolio, maybe 10%. I probably wouldn't do more than 10%, but I think, around 5 or 10% of your overall portfolio, I think there's nothing wrong with that. I much prefer investing into an ETF like this than investing into like Airbnb, Expedia, and these other companies directly. That's just me personally. But, a small satellite position, why not? I think if you're really interested in this type of strategy, I think is something you should consider. But I would highly recommend you go read another article, watch another video on this ETF, understand the dividend metrics, because that is not something that he discussed in this article. But nonetheless, I still give the article an A. I thought he did a great job. And yeah, I hope that the video was helpful. I hope that you learned something new, and I'll see everybody in next week's video.